Hi, welcome to another Bitcoin strategy video. This time with a little bit of a different format. Currently hiking here in Hong Kong and enjoying the nice sunset. Now that's probably not the reason why you clicked onto this video, but I still want to share this with you just to try like this new point and shoot kind of format. And so the topic of today's video is should you always be contrarian? So the question is basically, if you invest in crypto or if you invest in stocks or in property, whatever asset it is, does it make sense to kind of always go against the masses? So say when the mass is completely hyped, should you be cautious and should you be selling? And when the masses are incredibly scared, nobody is interested in an asset, should you then buy? Now I think the answer to this question is not really that straightforward. People say be greedy when others are fearful, be fearful when others are greedy. But there's also the exact opposite, right? People say don't catch a falling knife, or the trend is your friend. So what's in the end really true? What should you do? And I personally think it's probably not good to blindly buy when people are fearful. Because usually there is a reason behind this, right? Say when a stock is currently crashing, there's maybe a fundamental business problem behind this. If crypto is crashing, maybe there's actually some FUD in the market that has some substance to it. So just because others are selling doesn't really necessarily mean that you should be buying. So the worst I think that can happen is basically a gradual bleeding, right? When the attention on an asset is going from very hype to less and less fashionable, like less and less trendy. I think that's the worst case, because then momentum is against you, but there's also no real trigger point that makes people on the sidelines excited about buying, right? Say when you've got a real strong crash with a lot of liquidations happening. So say there was some kind of event, China banning something, or some new revelation, accounting wise, whatever it is, some drastic event that suddenly crashes the price. Then this usually leads to, where's the plane? There we go. Then the sudden crash usually leads to liquidations, so to forced selling, right? There are speculators in the market that work on leverage and they can only digest that much loss in a certain asset. And so once they get margin calls, once they get stopped out of their derivative, whatever it is, they have to sell. And this has a cascading effect, right? The first speculators, they sell, this drops the price. Then the subsequent speculators that were a bit more conservative, they need to sell because the price has just dropped even further. And so you have this cascading sell pressure, and this leads to a flash crash, right? In those kind of situations, buying the scalp does make sense in a lot of cases. So when there's basically a short-term exaggeration happening, the real bad news is maybe only worth 10% of price drop, but because of all the forced liquidations, the price may be dropped by 20 or 30%. And so then it basically makes sense to pick up the pieces, take the big discount and not wait until the price completely fully recovers, because there was some bad news, there was something that triggered this whole thing, but to basically just take advantage of the people that took too much risk, that had to sell and that sold below intrinsic value. And so the way you can see this in charts usually is a very strong decline in price, obviously, but also a spike in trading volume. If usually you have maybe, I don't know, 10 units of trading per hour and suddenly this spikes up to like 500, then you know when the price is crashing at the same time that there's probably a lot of forced liquidations happening and that it does make sense to take a short-term bet, a calculated short-term bet for a partial recovery of that price drop. So in those circumstances, it does make sense to catch a falling knife, to go against the overall trend. Now that's a sudden crash. That's the opposite of a gradual decline. In a gradual decline, you don't have necessarily forced liquidation. So these exaggerations in price movements don't happen when there's a gradual decline. And also the reference price of people in the market changes over time. So say when you've got a flash crash, the price goes from 100 to 50. Now everybody thinks, oh my God, the price was at 100, I get a 50% discount, that's a great chance. If, however, you decline from 100 to 50 within a year or two, then people don't really remember the $100 price point that much anymore. A lot of people might not even have bought at 100. Their reference price might be at 80 or at 60. And so $50 doesn't really look that much of a deal. And so gradual declines are dangerous. In that case, the trend is your friend and you shouldn't catch that falling knife. Unless you've got really a strong conviction that with that gradual decline, there was something going on in the market and you think it's still undervalued and you should just buy in for long term, you should DCA in maybe. But definitely be cautious. More often than not, if assets decline over a long period of time, they rarely turn around. And if they do turn around, it's normally because of some very special event happening, right? Like Apple declined for many, many years. But when did it turn around? Not just randomly. It turned around once Steve Jobs came in, replaced the whole board, all of management was gone. And so there was only the real core of the team left. And so he rebuilt the whole strategy, focused on a few products. And that then turned around this long-term gradual decline. But that's not usually what happens, right? Most of the time, bleeding companies, they just die a long death. Now, what about rising prices? Does it make sense when prices rise to sell? And here again, I think it does make sense to look at the pace of how quickly a price rises. And what you can very often see is that price appreciations, they tend to accelerate, not just in absolute terms, but even in relative terms. So when you look at the logarithmic chart of an asset, you will even see a steeper increase over time. So the percentage gains, they increase. And if you see this very strongly, then you're in hysteria mode. Normally you also see increased trading volume during that time, and then you should definitely start to sell. If the decrease, however, is again gradual and slowly, not accelerating, trading volume staying at the same level or at comparable levels at least, then just stick with the asset, right? It's good, it's appreciating. You don't want to sell your best asset. So there's also the saying, let your winners ride. That's basically the idea. If you've got the right horse, if you've bet on the right horse, just let your winners ride. And only once the masses get aware of everything, then start to gradually dollar cost average out of the asset and adjust your risk exposure. So what usually happens, especially with crypto, are these very exaggerated moves. And that's because the percentage movements, they are way more pronounced than for example, stocks or for commodities. If you have bought Bitcoin at the right time, or if you have bought even, say, Tesla at the right time, you would have made a multiple X on your investment. And that usually triggers sell pressure. Why? Because of portfolio rebalancing. So there's some kind of marginal utility to money, right? And you don't want to be completely overexposed to one single asset in your portfolio. Say you buy 5% or 10% of a certain asset and you get this 10x return on that asset. Suddenly it becomes 50% of your portfolio. Or let's say 33% if we are very specific about this. So 33% of your portfolio is suddenly this hyped asset with a lot of attention on it. And you definitely want to diversify out of this, right? You want to make sure that all of those nice gains, you're not going to lose them. If it can go up that quickly, who tells you that it can't at least partially go down again? So people rebalance, people sell. And so when you've got these very strong volatility in an asset, these very strong gains, in general like a strong growth curve, when your asset on average appreciates 200% per year as it used to be in Bitcoin, then you can't help but have those crashes simply because people need to rebalance and simply because hype are built. They just build up. Price increases, increased attention, increased coverage, and so there's no way that an asset can appreciate that much without swings. At least when you get a price on that asset every day, right? It's maybe a bit different for private equity where you have those funding rounds and where you don't see the volatility that much. But when you have an asset that is publicly traded, that goes up that quickly, you can bet for sure that there's also some kind of sell pressure here and there, simply because people have to rebalance. So in the end, it's basically two different models, right? On the one hand, you have this mean reversion idea. There's an intrinsic value to something and the price hovers around it. It goes way above and way below that intrinsic value. There are these hype phases and these big depressions where nobody cares anymore. And basically we always revert to the mean. And then you have the idea of trend following. You want to buy the winners, only a few winners survive, and markets tend to concentrate over time, right? The top engineers, they tend to go to the top tech companies, and thus the top tech companies, they stay at the top and they build monopolies. So the way I do this with Bitcoin is I DCA in and I DCA out of the market. So in general, I DCA in whenever I see the price has dropped for a bit and I feel compared to my overall net worth that I'm underexposed. So then I DCA in. What then happens is Bitcoin rises, right? And suddenly you're overexposed and you also see all this mania happening. Suddenly everybody talks about crypto, so then you should DCA out. And the reason why you DCA and why you don't just buy once with a big chunk and you sell once with a big chunk is because you can't really time the market. You can't really say when is the wave over, when is the depression done, when is the hype over and no new money comes in. It's really hard to time this exactly. You can only roughly gauge this. And so you know when there's a lot of attention that at some point this needs to end, but you don't know when. And so you start selling out, you're overexposed. And what's also interesting is that when you sell, you have to sell quicker than when you buy. So say when you dollar cost average into the market, right? There's not a lot of attention, not a lot of trading volume, not a lot of coverage. Nobody watches YouTube videos about something. Nobody cares about that asset. Then you DCA in and you buy every month X amount, let's say $1,000. Then you do this over a while, and maybe after a year or whatever it is, you have, it's just an example, 5% of your portfolio in that asset. Now you continue doing this, and then at some point you have maybe your target allocation. Let's say it's 10%. If the asset falls further, you continue buying again. If the asset now rises, you stop dollar cost averaging in, because now the asset is overweighted in your portfolio. You don't want to have 50% of your wealth in one asset that's going up and that's potentially going to crash. So you stop dollar cost averaging, you wait until the asset grows, then it does grow, and then once you notice that everybody around you is talking about that asset, people that normally don't talk about it, then you sell, but you don't sell 1,000 per month, you sell 2,000 or 3,000 per month. And that's because usually the price is at the elevated level for a much shorter period of time than at the depressed level. So the depressions, they happen really long. You have a long time to accumulate those Bitcoin, those stocks, whatever you're buying. But when it really pumps, when there's a lot of excitement, you usually get this big spike, and the price is at this elevated level for only a very short period of time, and then it crashes down again 30, 40, and as we have now seen in Bitcoin, 50%. So dollar cost averaging in is slower than dollar cost averaging out. That's something a lot of people oversee. Now let me know what you think of this kind of video style. Completely new format, just talking off my hip. Maybe you found an interesting thought or two. And if you want to see more of these kind of videos, and if you enjoy this kind of content, obviously please give this a like. Also obviously because of this nice plane over here, we rarely see planes nowadays. And of course feel free to subscribe as well. I publish videos 2 to 3 times every week. Greetings from Hong Kong. See you next time. Bye bye.